Okay. YouTube students, can you all see me now? Good morning, everyone. Yes, perfect. So I think I can start off now with this session. Okay, I believe everybody is added to the batch, right? Anybody yet left to be added over there? Anybody who's, yeah, I think there are 5 more requests are there. Let me accept all of them. Perfect, friends. So I think we are done with this question, and with this question, we are also done with financial leverages. Am I right? Yes. Friend, this leverage is a very easy chapter. You have more questions given over here. You can work out those questions yourself. All right. Yes, I think everybody has joined in, so I can continue now. Correct. Next chapter that we need to work out is ratio analysis. A very good chapter. Profit and loss account. This is all again leverage based questions. Okay, this is also leverage based. So there are a lot of simple questions are there on leverages. Now we start with the next chapter, ratio analysis. Friends, this chapter of ratio analysis, you need to learn it in 2 parts, friends. Part 1, hold on. Part 1, you need to correctly understand the logic of every formula. Now, when I say every formula, many of you will be thinking there are so many formulas. It is so difficult to by heart all those formulas. What you're saying is right. I don't want you to by heart all the formulas. I'll give you a simple technique today. Okay. Friends, audio video is all clear, right? Just a minute. Yes, I believe everything is clear. So I can start off, right? Please type a yes in the chat box. I can start off, correct? Okay. Okay. I think everything is good to go. I can start off now. So friends, when you talk about ratio, one minute. Little bit of sound is coming from here. Hello. Okay. Fine. So friends, when we talk about ratios, you actually have 3 to 4 different categories of ratio. In my language, okay, it's not about what you learn in your books, like there are profitability ratios, etc. In my language, so that I can explain the logic to you. First one is what I call it as percentage based ratios. Second one is what I call it as per unit based ratios. Then you have something called as turnover ratios. Along with this connected, you will be having holding period is something that comes along with the turnover ratio always. Then you have some coverage ratios like interest coverage ratio, debt coverage ratio, etc. Last, I will call it as miscellaneous. So let me give a few examples over here. First one, let's say GP ratio, very simple one. So what is the formula for GP ratio? Everyone tell me. It is gross profit divided by sales. Everybody clear with this part? Now, what about per unit based ratios? Let me say the answer is EPS. How do you find out the EPS, friends? It will be the total earnings divided by the number of shares. Correct? So let us say here it is 5 by 100 and you get the answer as 5%. Here let us say 100 or 1 lakh rupees is the earnings, 10,000 shares, so you get 10 rupees per share. Okay, turnover ratio, I can maybe call it as, let's say the company's turnover is, okay, I'll give you the next page. Can you first give this overview in your books first? All of you, can you please write it down? All right, friends. Are you all done writing till here? Okay. Okay. So now when I talk about the first one, what is the first ratio that we have over here? GP ratio. So I'll just start with this. So if I put 5 divided by 100, I get the answer as 5 percentage. Or let us say another ratio is 25 divided by 200. Then what will be the answer that you get over here? Do you get the answer as 12.5%? The logic for this 5 percentage is for every 100 rupees of sale, my GP is how much rupees? It is 5 rupees. Same way, when you talk about 12.5 percentage, it means for every 100 rupees of sale, my GP is how much? 12.5 rupees. So which one is better, friends? First one or the second one? Second one is better. Friends, like this, whatever percentage based ratio you take, this is the same logic for that. So for example, if you're talking about ROI, so it will be PAT divided by investment. So PAT is, let us say 10 lakhs. Let us say your investment is 50 lakhs. Do you get the answer as 20% over there? The logic of this 20% again is what? For every 100 rupees of investment, my PAT is how much rupees? 20 rupees. Everything that is in percentage will have the same logic. Can you quickly write down this in your books now? Alright friends, can I go to the next part? Friends, just WhatsApp me on my number if you're facing any doubts. Okay, these notes I'll share it in the group. If some of you are not there in the group, just message me. I will either add you to the group or I will somehow make these notes available for all of you. 8893495263. Okay, so I hope you're all clear with the concept of percentage based ratios. Other one that you have to learn is about per share ratio. So let's say EPS. What is the formula for EPS? Total earnings divided by number of shares. It will be 50,000 divided by 1000 shares. So do you get the answer as 50 rupees per share over there? What is the logic of this 50 rupees per share? Everyone tell me. It means for every one share I earn how much rupees, friends? I earn 50 rupees. Everybody clear with this part now? Like that, anything that comes per share, MPS, for every one share, my market price is this much. Every per share ratio will have the same logic. Please quickly write down in your book so that I can go to the next part. Perfect, friends. Everybody clear with this part? Next type of ratio is, let's say an example is current ratio. So let us say they are giving you a current ratio of 2:1. The formula for current ratio is what? It is the current assets divided by current liability. Or if I get the answer as 2/1 or we call it as 2:1, what it means is that for every 1 rupee of current liability, for every 1 rupee of current liability, 2 rupees is the current assets. So same way when you talk about quick ratio also, what will be the logic? For every 1 rupee of current liability, 0.5 rupee or whatever is the answer is the quick assets. Can you please write down this in your books now, friends? All right, friends, are you all clear with this part? Next, very important ratio is the stock turnover ratio. Here the formula is going to be cost of goods sold divided by average inventory. So let us say the cost of goods sold is 1 lakh. Average inventory is 10,000. So what is the answer that you get over here? Do you get the answer as 10 times over here, friends? What is the logic of this 10 times? The logic is inventory has to rotate how many times? 10 times to touch the market price. It has to turn how many times? 10 times so as to touch the market price. Are you all clear with this part now, friends? Okay, next thing. So once you are clear with this part, I will go to the next one. Okay, I'll go to the next part. So this is stock turn ratio. Same way we can also find out inventory holding period. Inventory holding period. So the formula for inventory holding period is 365 days divided by the stock turn ratio. So do I get the answer as 36.50 days? Or the logic is that if I buy some stock on January 1st, this stock will stay with me for how many days? 36.5 days. Or in this case, inventory is held in stock for how many days, friends? For 36.50 days. That is how we solve this particular equation. Everybody clear with this part now? Can you quickly write down this in your books now? Fine, friends. Are you all clear with this part? Can I go to the next question now? All right. So I think we learned about stock turn ratio. We also learned about inventory holding period. So any turnover ratio, debtors turnover ratio means debtors have to rotate how many times. That is the logic behind that. Or can I always say higher the turnover ratio, the better for the company? Better for the company. Everybody clear with this part now? Okay. Now, shall I go to the next one? So I think once you are done writing this in your books, let me 1 minute. Okay. All right. So I think last one is what? Coverage ratio. So here you learn a lot of ratios such as interest coverage ratio, for example. What is the meaning of interest coverage ratio? EBIT divided by whatever is your interest cost. So suppose my EBIT is 50 lakhs. I have an interest cost of 5 lakhs. Do I get the answer as 10 times? What does it mean? It means my EBIT is 10 times my interest. My EBIT is 10 times my interest. So the higher the better again. Can you please write down this also in your books now? All right, friends. So I think with this I have covered the ratio part. Let's do one thing now. I will open the ICI material. There they have given the summary formulas. That's very useful, friends. Let's take that formula and just quickly revise it and see if any one of the formulas has been left out by us. All right. All right. Just a minute, friends. All right. So here, if you see, you've got all the ratios and they are all in the methodology that I have already explained to you. Okay. Shall we just check it once? Okay. Summary of ratios are asked over here, friends. So first one, wait 1 minute. Okay. So as we learned, current ratio, quick ratio, they are all called as liquidity ratios, but these are all 2:1 format. So for every 1 rupee of current liability, what is going to be your current asset? Or for every 1 rupee of your this liability, how will this work out? Cash ratio also the same thing. For every 1 rupee of current liability, how much cash is available with you? This is another one ratio that we need to learn, basic defense interval ratio. Basic defense interval ratio. We have to break up this formula to understand the logic, friends. They have told cash, bank, net receivables. So basically they are talking about all your cash and liquid assets. Cash and liquid assets. Let us say that is turning out to be 100 lakhs. Point number B, 1 minute. Point number B, they have told divided by operating expense divided by number of days. Okay, so I'll write down my operating expense. Let us say operating expense is turning out to be in 1 year, it is 360 lakhs. Therefore, what will be my operating expense per day? Let's say it's 360 days is there in 1 year. So do I get the answer as 1 lakh rupees per day? Correct. How much is my cash asset that's kept with me right now? I think it is 100 lakhs. Let me change the 100 lakh and make it 10 lakhs. 10 lakhs. Therefore, my basic defense interval ratio will turn out to be 10 lakh divided by 1 lakh, correct? So do I get the answer as 10 days? Or the logic is with my available cash, I can manage for how many days, friends? I can manage for 10 days. Can you write down this also in your books now? All right, friends. Are you all clear with the logic of basic defense interval ratio also? Okay. Then rest are all okay. Net working capital is assets minus liability, whatever is the working capital available with you. Equity ratio is in percentage. For every 100 rupees of net assets, my equity is this much. For every 100 rupees of net assets, my debt is this much. I hope you understood that. Like that, everything you have to work it out, friends. Okay. One more ratio we need to learn is capital gearing ratio. Capital gearing ratio. So here the formula is going to be preference debt. So basically I will call it as outside funds. Debt and preference funds divided by debt and preference funds divided by own capital, equity plus reserves. So let us say this is 90, this is 100. Do I get the answer as 0.9, or the logic is for every 1 rupee of own fund, we have 0.9 rupees of outside fund. We have 0.9 rupees of outside fund. Can you write down this in your books now? Fine, friends. I think you're clear with the logic of capital gearing ratio also. Proprietary ratio is all same logic. DSCR ratio, as I told you, interest coverage ratio, same logic. How many times it covers? Asset turnover ratio, fixed asset turnover ratio, capital turnover ratio, all we discussed earlier, correct? And debtors velocity or holding period also we discussed. 365 divided by the GP ratio, NP ratio, operating profit ratio, expense ratio, ROI, ROA, ROCE, etc. EPS, DPS, dividend payout ratio also we learned. PE ratio multiple times. Okay, it will be rotating so many number of times. Dividend yield is in percentage. All that is also done, friends. Now only one ratio left, Q ratio. Last ratio before we get into a question. Q ratio. So now when you talk about Q ratio, it is market value of equity and liability divided by replacement cost of assets. This means my market value is, let us say, 100 crore. The assets when I replace, I will get only 20 crore. So do I get the answer as 5 times, or the logic is my company's market value is 5 times the replacement cost. Is 5 times the replacement cost of the asset. Can you please write down this in your books now, friends? All right, friends, I believe you're all done with this part also. So with this, we are done with the conceptual part of ratios. Shall we start cracking questions on this part now, friends? Okay, so let us do question number 11 now on ratios. So friends, ratio analysis is one part where you don't need to write down the basic data because it will be a very time consuming process to do that. So we'll just read the question. You have a balance sheet, application of funds is given. Down they have given you P&L account also. From this they are asking you to find out the inventory turnover ratio. Everyone tell me what is the formula for inventory turnover ratio. So I'll draw a table, particulars, 31st March 2020, and what is the other one? 31st March 2021. Okay, so point number A. Point number A. They want to find out the inventory turnover ratio. Am I right? Yes. So inventory turnover ratio, how do you find out? Cost of goods sold divided by average inventory. They're asking you to find out for 2021. Okay, so they want you to find out for 2021. Fine. In that case, I'll remove this. They want it for 2021. So can you tell me what is the cost of goods sold? How do you find out the cost of goods sold? Opening stock, I think they have directly given it. 7,38,500 divided by average inventory. So friends, for that we need to go and find out the average inventory. That we'll get it from the balance sheet. See, you have the opening inventory, you have the closing inventory. So we take the average of this 87,500 plus 70,000 divided by 2. So tell me now what is 87,500 plus 70,000 divided by 2? Do you get the answer as 78,750? Correct? So based on this, can you tell me what will be the inventory turnover ratio that you get over here? That will be A divided by B. Do you get the answer as 9.37 times? Am I right? Perfect. So that is the answer for the first one. Shall we cross check with the solution over here? 9.4. We also got the same answer, friends. Right? Second, they are asking you to find out. Okay, can you quickly write down till here in your books? Alright friends, everybody clear so far? Next thing what they are asking you to find out is the financial leverage. How do you find out the financial leverage? Everyone tell me. EBIT divided by EBT will give you what? It will give you the financial leverage. So let's check it this way now. So what will be the financial leverage that you will get? How much is the EBIT? 33,250, 22,750. 33,250, 22,750. So what is 33,250 divided by 22,750? Do you get the answer as 1.46 times? This is what you call it as financial leverage. Financial leverage. Are you all clear? Can we cross check the answer over here now? 1.46. Last they are asking you for what? ROCE, return on capital employed. So what is the formula for return on capital employed? EBIT into 1 minus tax. Why are we taking it like that? Because when you talk about capital employed, it should be before your equity and debt payments. So EBIT is your payment before interest. From that we reduce tax because tax advantage both of them will get. Divided by average capital employed. When you do like this, you get the answer as 11.56 percentage. Can you all please write down this in your books now? Are you all comfortable, friends? Please type a yes in the chat box if you are comfortable. Perfect. Yes, friends. Are you all done writing so far? Okay. Let me now go to the next question. This one is an easy problem. You can do it yourself. Let's do a little tricky one now. Wait. Okay, now friends, question number 13. Now since you know how to do it, I want you to work out question number 13 on your own. Alright, what and all are they asking over here? Net profit margin. What is the formula for net profit margin? Can you tell me? NP divided by sales. How do you find out net operating profit margin? Operating profit divided by sales. Everybody clear? Return on assets. How do you find out ROA? Return on assets. There are multiple ways. The best way is EBIT into 1 minus tax divided by whatever is your total assets. Everybody clear? ROE. How do you find out ROE? Profit after tax divided by equity plus reserves. I hope you're all clear with this part now. Can you please write down this and try getting the answer yourself? I don't want to help you. Take 5 minutes time, but do it yourself. Yes, friends, tell me now. Are you able to do it yourself? I'll explain this answer now. Total assets is given. Debt to total assets ratio is given. From this, can you find out the debt? Once you get the debt amount, on that 10% will be your interest. Okay. Interest, once you get into 10 times, will be your direct cost. Okay. Now, after direct cost, OPEX is also given over here. So, when you do a reverse working, you can find out the GP ratio, and the cost of goods sold is also given. So, look at this. You have debt of 5 lakh, interest 50,000, direct cost 5 lakhs. So, if direct cost is 5 lakh, they have told the GP ratio is 50%. So, sales will be 7 lakh 50,000. Everybody clear with this part? 150% of the direct cost. Okay. Then your GP will turn out to be 2,50,000 minus OPEX, EBIT, interest, EBT, tax, PAT. Take 5 minutes. Can you write down this in your books? And if you have any doubts, you let me know. All right, friends. Are you all done writing till here in your books now? Shall I go to the next part? If you are still doing, type ND. That means not done. This chapter of ratio analysis, it is something which has to be done by you, friends. Okay. Take your time, Aratrika. I'll give you time. It's all mathematical derivation. So my contribution in this chapter will be less. I'll show you questions. You solve it here in the class itself and get the answers. All right. Whatever doubts you get, you can ask me. All right, friends. Are you all done writing now? Perfect. So I hope you are clear with this. Then they are asking you to find out the net profit margin, that is PAT divided by sales, 9.33%. Net operating profit margin will be EBIT divided by sales, 20%. Everybody clear? ROA 10.5% and ROE 14%. Quickly write down this also in your books. Then we go to the next question. So whenever you do ratio analysis chapters questions, it's all about your analytical skills, how much of the ratios you have a very good grip on. So this chapter needs a lot of practice, friends. All right. So I think you are done with this. Perfect. Let's go to the next question now. Next question is also a very good question. We'll do this one more question on ratio analysis. All right. So now, following information and ratios are given for W Limited for the year ended 31st March 2022. So I'll write question number 14. Working note number 1. Basic data. So there you have a share capital of how much? 10 lakhs. Equity share capital of 10 lakhs. I think it is 1 lakh shares into 10 rupees each. That is how you get 10 lakhs. Am I right? Reserves and surplus to shareholders funds is 0.5. So reserves and surplus divided by equity plus reserve is equal to how much, friends? 0.50. Okay. So I believe we can solve it here itself. I can put it as X as reserves divided by 10 lakh plus X should be equal to 0.5, or X is equal to 5 lakhs plus 0.5X. Correct. So then you will get 0.5X is equal to 5 lakhs. Therefore, X is equal to what, friends? 5 lakh divided by 0.5, or do you get the answer as 10 lakh rupees over here, friends? So like that you can find out your reserves and surplus. Let's confirm the number is correct. Yes, you have got the same 10 lakhs as the answer. Can you all quickly write down till here in your books now? Alright friends, so I think you're clear with part 1. Let me go to the next part. So once we get the first part and we got the reserves, now we know equity is 10, reserves is also 10. Sales to shareholders fund is 1.5. So I'll write down the next working note heading. Sales to shareholders funds. So the formula will be sales divided by 20 lakhs is equal to how much, friends? Is equal to 1.5. Therefore, how much will be the sales that you will get over here, friends? Will you get the sales as 20 into 1.5, or do you get the answer as 30 lakhs over here, friends? Okay, 30 lakhs will be the answer that you will get over here. Everybody clear with this part? Can I go to the next one now? Okay. So once I get sales to shareholders fund, they have given you the current ratio as 2.5. Next working note we will write down current ratio. So what's the formula for current ratio? Everyone tell me. Current assets divided by current liabilities. Current liabilities. This is equal to how much, friends? This is equal to 2.5. Am I right? Okay. So I think as of now, I don't know what is the current assets. I don't know the current liability. I'll keep it pending. Debtors turnover ratio is 6. So next page I will go and write down. What is the formula for this? Total turnover divided by average debtors, correct? is equal to how many times? 6 times. Therefore, I think we got the sales as how much, friends? Sales was 30 lakhs. Okay. So 30 lakh divided by debtors is equal to 6. Therefore, debtors will be equal to 30 lakh divided by 6, or do I get the answer as 5 lakhs, friends? My debtors will be 5 lakhs. Everybody clear? Okay, so I got debtors. Please write down this in your books now. My dear YouTube students, please type a yes in the chat box to confirm that even you're comfortable with the entire thing. It's perfect. All right, friends. So we are done with debtors turnover ratio also. Can we go to the next one now? Okay. So after debtors turnover ratio, next they have given the stock velocity is 2 months. So how do you find out the stock velocity? I'll tell you. It can be average inventory divided by cost of goods sold into 365 days. Unless the question says 360 days, it will be taken as 365 days should be equal to what? 2 months. Or if it's 2 months, I'll put it as 12 months over here. Into 12 will give you how many months? 2 months, is it? All right. So now, have they given the average inventory anywhere? Cost of goods sold anywhere? No. But they have given you the GP ratio. GP ratio is 20%. So cost of goods sold ratio will be 80%. So can I say it will be average inventory divided by 30 lakh is the sales into 80% will be your cost of goods sold into 12 is equal to 2. So now when I solve it, it will be 24, 2 into 24 divided by 12. I will get the average inventory as 4 lakhs. Everybody clear? So I got earlier debtors as I think 5 lakhs. Now I have got inventory as how much? 4 lakhs. I think in current assets, we need to just find out cash now. Debtors, inventory and cash normally will be the current assets. Net working capital turnover ratio is how much, friends? Wait, I think you're still writing. Can you write down this in your books now, all of you? All right, friends. I believe all of you are clear with this part now. Okay. So once you are done writing till here in your books, next part, I think net working capital turnover ratio. Net working capital turnover ratio. Correct? So the formula for this one will be turnover divided by net working capital is equal to 2.5. So 30 lakh divided by net working capital is equal to 2.5. Therefore, net working capital will be equal to what? Do I get the answer as 30 divided by 2.5, or do I get the answer as 12 lakhs? Or in other words, current assets minus current liability is equal to 12 lakhs. Friends, now I think I'm just going to try a new method. If you don't get it, we'll go by this textbook method. All right. So we have got two equations now. What's the first equation that I have? CA minus CL is equal to 12 lakhs. CA divided by CL is equal to how much? 2.5. So from this, can I say CA is equal to 2.50 CL? Am I right? So in the place of this CA, if I replace this, can I not say that 2.5 CL minus CL is equal to 12 lakhs? Therefore, 1.5 CL is equal to 12 lakhs. Therefore, CL is equal to 12 lakh divided by 5 lakhs. Or do I get the answer as 2.40 as my current liability, friends? Sorry, divided by not 5. Sorry. I made a small mistake in the end. 12 lakh divided by 1.5, correct? So do I get the answer as 8 lakhs over here? Once I get this as 8 lakhs, therefore my current asset will turn out to be what, friends? It will be 12 lakh plus 8 lakh. So does that turn out to be 20 lakhs? In this 20 lakhs, we have already got my debtors as 5 lakhs, my inventory as how much? 4 lakhs. Therefore, my cash will be the balancing figure. How many lakhs will come as my cash? It will be 11 lakhs. Are you all clear with this part now? Yes. Can you write down till here in your books now? Perfect, friends. So I think we are done with this question. With this, let's check. Shareholders funds, we got stock, we got debtors, we got, yes, we got everything. I think even the cash balance is 11 lakhs. Confirm. Yes, 11 lakhs. So friends, we are done with this question also. Is everybody clear with the concepts taken so far? So now friends, as far as this chapter of ratio analysis is concerned, like this we can keep on solving more and more questions, and you will be getting the same way solution and the answers, friends. I hope you are all comfortable so far, friends. Yes. Now we'll go to the next chapter. Okay. So we have covered quite a lot. We have covered leverages, we have covered dividend policy, we have covered ratios. Now let us cover the next chapter. Okay. Now, friends, we'll go to the chapter of capital structure and cost of capital. I think I'll first start with cost of capital logic. Okay. Now, I'll just put the next heading, cost of capital. Friends, cost of capital consists of the following things: KE, KD, KP. If you want, we can put one more thing called as KR, that is the cost of retained earnings. Okay. KE is whose expectation? Equity holders expectation. KD is whose expectation? Debt holders expectation. KP is whose expectation? Preference holders expectation. KR is again what? Retained shareholders expectation. Can you please put this chart in your books first? All right, friends, are you all done writing till here in your books? So, ideally, KE can be found out using multiple formulas, but the best formula is which one? CAPM, that is RF plus beta into RM minus RF. This is the best formula. Other one way how you can find out is using Gordon's model. What is the formula for Gordon's model? D1 divided by KE minus G. Or if I rework, can I say KE is nothing but D1 divided by P0 plus G? One other method that many books use is the P multiple approach. As per P multiple approach, 1 divided by P ratio is also equal to what? KE. These are the three ways in which we can find out KE. But what is the best method? Everyone tell me, friends. The best method is CAPM method. Everybody clear? Okay, all right. I believe all of you are clear with this part now. Can I go to the next part? Okay. So once you are done writing about KE, next one is KD. KD we can find out for two different things. First one is called as the redeemable debt, and the second one is what we call it as irredeemable debt. Friends, irredeemable debt is easy because this is a debt that goes towards perpetuity. Irredeemable means you have unlimited life. So now tell me, if something is going towards perpetuity, we use the perpetuity formula. What is the perpetuity formula? Cash flow divided by discount factor. In case of debt, what is the cash flow? It is the interest into 1 minus tax divided by interest into 1 minus tax divided by what, friends? Divided by the market price, or P0 should give you your KD after tax. Here we use a method called as approximation method. As per that method, the formula will be interest into 1 minus tax plus redemption value minus issue price divided by life whole divided by redemption value plus issue price divided by 2. Can you write down this also in your books now? So this answer is actually approximate KD. I will not tell it is the accurate answer. For accurate answer, we should do IRR, but that's not required at the CA inter level that you learn at the CA final level. Inter level, this much is enough. Alright friends, are you all done writing till here in your books? Okay, now I'll go to the next part. Next part after KD we'll find out for KP. That is preference holders expectation. This is also going to be the same as KD. You have two types of preference shares. You have redeemable preference shares. You also have irredeemable preference shares. So what is the formula for redeemable preference shares? It is the preference dividend plus redemption value minus issue price divided by life whole divided by redemption value plus issue price divided by 2. Same thing. There it was interest after tax. Here that is not coming in. Irredeemable. Earlier what was the answer? It was interest after tax. Here it will be preference dividend divided by P0. That's it. This will give you the KP. Can you write down this in your books now? All right. Last one is what? KR. Okay. This is nothing but it is the cost of retained earnings. So this is same as KE. There is only one place where this changes. When you are going for new equity share, you have an issue cost. Okay. So I'll just put it this way. New equity shares, existing equity shares. So when we speak about existing equity share, in this case my K and KR will be the same because there is nothing new coming in. In case of new equity share, my KE will have one more thing which is called as issue cost. But my KR will be calculated without considering what? Issue cost. This is the main difference between KE and KR. Are you all clear with this part now? Fine, friends. Are you all clear so far? Perfect. So I believe we are all done with this part now. Shall I go to the next one? Okay. So now that we are clear with the entire cost of one more thing, there is one more concept called as WACC. So WACC, the formula will be KE into weight of equity plus KD into weight of debt plus KP into weight of preference. If you have KR, you can also call it as KR into weight of retained earnings. But normally that is merged with KE into weight of equity itself. Now they may ask in the exam something called as marginal WACC, or this means working capital additional. So for the new fundraise, what is the working capital? For this, the formula will be additional KE into weight of equity plus additional KD into weight of debt plus additional KP into weight of preference plus additional KR into weight of retained earnings. Can you write down this also in your books, friends? After this, we'll start cracking questions on cost of capital and capital structure. All right, friends, I believe all of you are done. Shall I go to the next part now? Okay. So now considering this, let us crack a question together. Let us do question number 17. Ready? Okay. Working note number 1. Basic data. So what is the basic data? Jason Limited is planning to raise additional finance of how many lakhs? 20 lakhs. So I'll write down additional finance is equal to 20 lakhs. For meeting its new project, it has 4,20,000 in the form of retained earnings. Retained earnings is equal to how much? 4,20,000. Okay. For further details are given below. Debt equity ratio is given as 30:70. Is equal to 30:70. 1 minute. Cost of debt up to 3,60,000 is 8%, and beyond that is again turning out to be 12%. So basically, KD up to 3,60,000. 1 minute. Okay, KD is how much? 8%. Next part, KD after 3,60,000 is equal to how much? 12%. 12% before tax. Are you all clear with this part? EPS is 4 rupees. We'll understand the question thoroughly. Dividend payout 50%. So can I find out the DPS here itself? How much is 4 into 50%? Everyone tell me. Do you get the answer as 2 rupees over here? Then current market price 44 rupees. Current market price 44 rupees per share. Expected growth in the dividend 10%. And the tax rate is how much? 40%. Put up this data first. We'll understand the data thoroughly. After that, we will solve it together. All right, friends. Are you all done writing till here in your books? Fine. So now they need an additional funding of how much, friends? They need extra funding of 20 lakhs. But what is the debt equity ratio that they are following right now? What is the debt equity ratio? 1 minute. 3:7. So their debt should be only 30%. And their equity should be the remaining how much percentage? 70%. Correct. So here, do you get the answer as 6 lakhs? Here you will get the answer as how much? 14 lakhs. In this 14 lakhs also we'll break it up into two parts. We can take it as equity or it can go in by way of reserves. And if I'm not wrong, they have already given the reserves also in the question. What is the reserves they have told? 4.2 lakhs. Therefore, what will be the equity that comes over here? 9.8 lakhs. Let's confirm. Yes, 14 lakhs, 9.8 lakhs. Whatever we did is correct. Can you draw this diagram in your books now? All right, friends, are you all done writing till here in your books now? Can I go to the next part? Okay. So once we are done with the first part, we got to know how much will be the debt, how much will be the equity, correct? So I think we got 6 lakhs as the debt. Now up to, I think here also we can put a chart now. And as per this chart, up to 3,60,000, the interest is going to be 8%. So 3,60,000 into 8% will come. Balance, how much is coming on top of that? 2.4 lakhs, correct? On that 2.4 lakhs, they're going to pay interest of how much percentage? 12%. So what is 3.6 lakhs into 8%? Is it 28,800? Other one is also turning out to be how much? 28,800. So when you add up these two numbers together, do you get the number as 57,600, friends? Okay, please write down 57,600. $57,600. Alright, are you all clear so far? Yes. And I think we also got the reserves part is also clear over here. Let me go to the next part now. Okay. So I think here I got finance, retained earnings, debt equity. This is done. EPS is given. We will come to that part later. DPS is also given. MPS is also given. Growth is given over here. And tax rate is also given over here. We'll come to all that part later. I think we have got the first part. So now what are they asking? Let us check. To determine the cost of retained earnings and cost of equity. So they want to know what is going to be the KE. So tell me, friends, how do you find out the KE? I'll write down the next working note. Cost of equity. So cost of equity, as I told you, either I can use Gordon's model or CAPM. Here they have not given beta etc. So I'll go by Gordon's model. So D1 by P0 plus G. So therefore, I think in the question we have D1, correct? I think we got D0 as how much? We got the D0 as 2 rupees if I'm not wrong, correct? Have they got the growth rate also given over there? 10%. Okay. And market price is 44. So the answer will be D1 will be 2 into 1 plus 10%, that is D1 divided by market price plus 10%. So when I do like this, do I get the answer as 15%? It's 15%. I think you would have not taken the D0. 2 is D0. When you take from earnings, earnings is EPS. EPS is always E0. So EPS into this thing will give you D0 only. D0 plus 10% will give you D1. Everybody clear? So I believe all of you got the answer as 15% over here, friends. To determine the post-tax average cost of debt. So what is the formula for KD? Next to working note heading will be cost of debt. So there we learned the formula. Interest into 1 minus tax divided by P0 will be your KD. Correct. So I think we got the interest amount as how much over here? 57,600 divided by total debt amount that we have is 6 lakhs. Sorry, 57,600 is before tax, correct? Into 1 minus 30% if I am not wrong. What is the tax rate? 40%. So into 1 minus 40%. Do you get the answer as 5.76%? 5.76%. Everybody clear with this part? Alright, so we are done with the second one also. We got cost of equity and retained earnings will be the same. We got the cost of debt. Determine the pattern for raising additional finance. We already did that. Overall weighted average cost of capital. So last they want to find out the WACC. Now tell me how will you find out WACC? That will be KE into 15 into I think 70% is the weight of equity plus KD is 5.76 into 30%. Do I get the answer as 12.228%? Alright. Everybody clear with this part now? 12.228%. Can you write down this in your books and finish it off? Are you all clear so far, friends? Let's go and check the answer now. Yes, cost of retained earnings 15%, cost of debt 5.76, pattern of fundraising also we got 12.223%. Everybody clear with this part, friends? Please type a yes in the chat box. Anyone still writing, type ND, or else we'll go to the next question now. Perfect, friends. Can I go to the next part now? Okay. So let's do the next question on cost of capital. Cost of capital is a chapter where sure short questions will come. Let me read the next one now. Okay. Question number 18. Working note number 1. Working note number 1, basic data. Point number A. So here they have told 12%, 6,000 debentures of 100 rupee each is there. So 6 lakhs. So from this, can I find out the interest amount now? So I'll write down point number A, debenture interest. Debenture interest is equal to 6 lakhs into 12%. Do you get the answer as 72,000 rupees? Yeah. Point number B, retained earnings is given, equity shares is also given. Current market value of debenture is 110. Market value of debenture is 110 rupees. Okay. Wait. I think we can find out debenture interest per unit. There I have found out the total. So what is the face value is 100, right? That will be only 12 rupees into 1 minus tax. What is the tax rate? 30%. Do you get the answer as 8.4 rupees per debenture? Per debenture. Alright. Now, current market value of the debenture is 110 and the equity share is 180 rupees. MPS of equity share. So, MPS of equity share is equal to 180 rupees. The expected rate of return of equity shareholder is 24%. So that is KE. KE is directly given over here, friends. KE is equal to how much percentage? 24% is your KE. Now they want you to find out the WACC. That's all. Can you write down the basic data in your books, friends? Working note number 1, basic data. Alright friends, are you all done writing till here in your books? Why did we not consider market value? Arthrika, let me explain to you. Interest is always on the face value, right? You never pay interest on the market price of debenture. Market price may increase or decrease, but interest is always on the face value, correct? Right. So I think once you are done with this, I need to now go and find out KD. So I'll write down working note number 2, KD. KD after tax. So I think I already got the interest amount, that is 8.4 divided by 110, correct? Do you get the answer as 7.63% friends? 7.63%. So I got KD also. Now I need to go and find out what? I need to find out the WACC. So when I do WACC, I'll put a table like this, particulars. Okay, so here I'll write KE, KD, cost of capital. How much is the cost of capital for KE? Is it turning out to be 24%? What about KD? 7.63%. Now I need to put the market value because they have told find out the weights based on market value. One very important point over here, friends. Weights can be either done based on market value or weights can be done based on book value. Here they wanted to do it based on what? Market value itself. So what will be the market value? 6,000 debenture into 110. Is it turning out to be 6,60,000? And what about KE? Market price is 180, 4,500 into 180 shares. 8,10,000. Do you get the total as 14,70,000? So what is the weights that you get over here? 55.10%, 44.9%. So now once you get this, you will have to do the weighted average, correct? So how will the WACC come now? 24 into 0.5510, that is 13.224. 7.63 into 0.4490, 3.425. Do you get the total as 16.65%, friends? Let me cross check the answer. Let me just confirm the numbers. 16.98 is what they got. I got 16.65. I think that's a rounding off difference. 8.4, 45, 55. Okay. It's a rounding off difference. So 55 into 0.24. Yes. Yes, 3.78. All right. Can you write down this and finish it off, friends? So we are done with this question also. Arathrik, I believe you are clear, right? Take 2 minutes, write this down, then we will go to the next question. Are you all comfortable, my dear friends? Please type a yes in the chat box. We have covered quite a lot of questions, friends, in a short span of time. These are all very good past exam questions only. So let's hope such questions come in the exam and you get excellent marks. Please don't forget to message me after your results, okay? Write down, take 2 minutes. Yes, friends. Are you all done writing till here in your books now? Okay. So I think once you are done writing this, let me go to the next question on cost of capital. This is a very good question. Let's do this question. Okay. Question number 19. Question number 19. Working note number 1. Working note number 1. Basic data. Okay. Yes. Ordinary shares 5 lakh 10 rupees. So do you get the number of shares as 50,000? So I'll write down 50,000 shares into 10 rupees equal to 5 lakh. Okay. Next one. Point number B. Share premium is 1 lakh. Okay. Share premium 1 lakh. Retained profit 6 lakhs. 8% preference shares face value of 25, or wait 1 minute, from this I can take 5 plus 1 6, 6 plus 6 12. So shareholders funds 12 lakh. This is basically equity plus reserve. Point number C. 8% preference shares having a face value of this thing is 4 lakh. So 4 lakh divided by 25 is how much? 16,000. So I'll write down 16,000 preference shares into 25 rupees per share. Do you get the answer as 4 lakhs? Okay, you get the answer as 4 lakhs. Everybody clear? So this is 8% preference dividend. Next part. What is the next thing that is given over there? 12% debentures of 100 rupees each, 6 lakhs. That is 6,000 debenture. I think we have put up the basic data. The ordinary shares are currently priced at 39x dividend. Okay, so I'll write down MPS of equity share. Market price of equity share is how much? 39 rupees x dividend. Normally we always take x dividend only. The preference shares are priced at 18 come dividend. So that is why, so we need to remove the dividend part from this. So this will be, already it is 18 rupees. Come dividend means cumulative of dividend. If I remove dividend, it will become what? It will become x dividend. Everybody clear with this part now? So now in order to remove this, what I'll do is I'll take the preference shares. What is the 25 is the face value, 8%. So what is 25 into 8%? 2 rupees. So the moment you remove it, you get the number as how much? You get the number as 16 rupees over here. 16 rupees over here. All right. The debentures are selling at 120% x interest. So MPS of debenture will be 100 rupees into 120 percentage. So do I get the answer as 120 rupees? 120 rupees. Down they have told the tax rate is how much? 30%. Tax rate is 30%. The cost of equity is estimated at 19%. So the KE is equal to how much percentage? 19%. Calculate the WACC of KD on the basis of the following. So can you first put the basic data and understand the question, friends? All right. I believe all of you are done writing till here in your books. Can we now try solving it together? So we have to go one by one. We already have found out KE. Now what do we have to find out next? We need to find out KP. So how do you find out KP now? So I'll write down the next working note heading. Cost of preference shares. Cost of preference shares. Okay, shall we do this now? So when you do the cost of preference shares, let me just come down. I think they have given you the market price and the dividend is also given. Correct. So what is the formula? Preference dividend divided by current market price. So here I think 16 rupees was the preference dividend. Correct. Divided by what is the current market price of the preference share? Sorry, 16 is the current market price. The dividend amount is how much? 25 into 8%, that is 2. So it will be 2 rupee dividend divided by 16 rupees. Do you get the answer as 12.50%? Next working note heading will be what? The cost of debt. What is the formula for cost of debt? Interest into 1 minus tax divided by P0. So now tell me how much is the interest that we got over here? 12% interest, that is 12 rupees into 1 minus 30%. I assume the tax rate is 30%. Yes, whole divided by P0, or the current market price of the debenture is said to be 120 rupees. Correct? Do I get the answer as 7%, friends? So we have got KE, KD and we have got KP also. Am I right? Can you please write down till here in your books now?
CLTB and I Shakir.
Alright friends, are you all done writing till here in your books now? Perfect. So once you are done writing till here, let me just go to the next part. Now they want you to find out the WACC on the basis of market value. So now again I'll have to put, I'll write down the next working note heading, WACC, particulars, cost of capital, market value, weights, weighted average cost of capital. So KE, KP, KD. How much is my KE that is coming over here? Is it 19%? What about my KP? KP turns out to be 12.5%. And what about KD? KD is how much? 7%. Now to get the market value, I think we have got the numbers. What was the market price for the first one, equity share? That is 50,000 shares are there into what was the market value? 39 rupees, correct? That is 19,50,000. Okay. What about preference shares? I think the preference shares market price is 16 rupees, correct? So 16 rupees into how many preference shares? 16,000. Do I get 2,56,000? $2,56,000. What about cost of debt? What about cost of debt, KD? That is estimated to be 1 minute. Oh, you have 6 lakh divided by 100 is 6,000 into 120 rupees. 7,20,000, correct? Now, what is the total that you get over here? Do I get the total as 29,26,000? Then you have to find out the weights and you have to do it. Can you do the remaining part on your own, friends? Let me confirm that I've got the numbers correct. 19,50,000, 2,56,000, 7,00,000. Yes, friends. Now can you write down the remaining and do it? Why are we not considering KR? Have they given KR separately in this question? It's not given, right? So whatever is KE and KR will be the same. Yes, both of them will be the same. There's a retained profit of 6 lakhs, but when you take it based on market value, your equity's market value is your equity plus reserve plus the goodwill value, correct? So you don't need to take it separately. If it was based on book value, what you said is correct. We'll take book value of equity plus book value of reserve. But when you're doing it based on market value, equity's market value already is after considering retained earnings. I hope you are clear now. Do you get the WACC over here as 15.47% friends? Yes. Do you all get the answer as 15.47%? Perfect, friends. So we are done with this question also. Now, friends, shall we take a break? Time is almost 12:30. In the next 5 minutes, I won't be able to cover one more question as such. Okay. So shall we take a break? After the break, we'll do one question on the capital structure, levered and unlevered, which is a little bit of an illogical problem, but we'll do that. Then we will move on to working capital management. Everybody clear with this part? So shall we take a break now? Perfect. So friends, we'll take a 1 hour break. We'll get back at 1:30. And then from 1:30, we'll have our final session up to 3 o'clock. Alright. So see you after the break, friends. Thank you so much.